On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets.
Right, morning team. I am on holiday at the moment for the long weekend, but I was still keen to jump on here and share a few thoughts because there's so much going on in markets that I can't help myself. But bear with me. I haven't got my usual information in front of me, and I also haven't got a decent microphone, so I'm doing this on my phone, so it might not sound as good as usual, but with a bit of luck, I still might be able to share a few thoughts that will help inform people. So let's look back at markets last week, and it was a really tough week actually for share markets around the world. The US market was down, the S&P 500 that is, down 2.4%. The UK market down by about the same. Europe was off a little more than that. It was off 3.4%. Markets here in New Zealand and Australia fell to 2.5%. So the volatility and the weakness has continued. If we look back at the peak for this year, the S&P 500 peaked at the end of July, NZX 50 peaked at the end of July as well. Since then, both of those indices are down 7.9% and 8.8% respectively. So not quite in that correction territory, which we sort of think about as being, down 10% from a peak, but certainly weaker through the month of August, September, and so far in October. A lot of that weakness has been because of higher global bond yields, and we saw the US 10-year Treasury yield last week push through 5%, so that's the highest it's been in 16 years. Sort of a milestone there. Got a lot of attention being through that 5% level. And this puts pressure on asset classes across the board when you've essentially got risk-free assets that are providing such attractive yields. That's sort of a building block for how we value other things. So it means the hurdle for the returns that people expect of things like shares and property and other assets is higher again. So because of that, you see prices fall in all of those asset classes. So those treasury yields and those bond yields you're seeing in the US, here in New Zealand, elsewhere, are really causing that volatility across financial markets generally. And it's difficult to know where that will end. Could bond yields push higher? Yes, they could. Let's talk about some of the reasons really quickly why they're as high as they are. It's better growth. Better growth means that bond yields tend to be higher. That also tends to mean that central banks will keep interest rates higher for longer, and that's a message that the Federal Reserve and others have talked about a lot lately. So it's those two things playing into the mix. Better growth, obviously, and a stronger economy is a good thing. While it does mean bond yields are higher, it also provides a better backdrop for corporates and for business. So it's not all bad. It's a bit of a double-edged sword. You've also got higher deficits from governments. With the US, with such an uncomfortable fiscal position in terms of their debt levels, that means they have to issue more bonds, and that does put upward pressure on bond yields. So it's a range of things that are really causing bond yields to push higher, and we don't know how much further they'll go. Could they go a little bit higher? Yeah, absolutely. I think if you look back at that period in 2007, the US 10-year Treasury got to about 5.3, 5.4. So that's just probably as good a yardstick as anything to use in terms of where they could move to this cycle. You go back further, and the last time they were this high, apart from that period, was sort of 2001, 2002, and then you look back through the 90s, and they did go higher again. It is a little bit different because I think the levels of debt that the world has are so much higher now than 30 years ago. I think that tipping point where the higher bond yields start to cause problems is probably lower. And that's a really important concept to consider, because in a way, you know how they say the best cure for high prices is high prices? Well, you could say the best cure for high bond yields is high bond yields. And what I mean by that is, even at current levels, certainly if they go any higher, someone's going to be hurting somewhere. You are going to start to see stresses emerge, whether it's in parts of commercial real estate or credit or private markets in some parts of the world. Something will go wrong somewhere. Always difficult to know where, but when you get these hiking cycles where interest rates move up from very low levels to higher levels, you sooner or later see something break somewhere. And I think that will potentially be the case this time. That doesn't mean you're heading for another GFC or anything, but it does mean that somewhere you'll start to see those stresses emerge, and that can then put pressure on growth, and you can find yourself in a situation where the economy starts to stumble a little bit, and then central banks have to cut rates. So that's something that will sort of limit how high bond yields can go and how long they can stay there for. That again remains to be seen, but what it does mean is that if we look ahead 6 months, 12 months, 18 months, there is a reasonable chance that we won't have bond yields as high as they are. So it's a watch this space, and it's causing lots of volatility and uncertainty across markets. But that is how I would be thinking about these higher bond yields in a longer term sense or a medium term sense. The other thing outside of bond yields that is really keeping markets on the back foot or just a little bit uncertain is obviously what you're seeing in the Middle East in terms of the conflict. And at the moment, you haven't seen oil prices really spike too much. You have seen the conflict contained, but I guess there is a risk that things will escalate and other countries will be drawn into the mix. And the real risk there is that sort of the US gets involved, or Iran, who obviously backs Hamas, and Hezbollah, who is off on the fringes and hasn't yet sort of played a role, and hopefully they don't. But if some of those nations start to get drawn into it, that's when you start to see the financial impact at least start to become a bit more widespread. So that's very much a watch the space. I'm conscious that a lot of people are nervous about that. You know, it's always hard to predict where these geopolitical events will end, or whether they will get worse. The US doesn't want things to escalate. You know, I think that's why they've sent the USS Gerald Ford across, you know, the big aircraft carrier. They've got an election next year. Biden's already got a low approval rating. The last thing they need is to get involved with a war that the American people aren't wanting them to get involved with. Oil prices going up, that wouldn't help the cost of living issues that they're already grappling with. So the US has very much got an incentive to keep things contained, and hopefully things don't get any worse than they already are. But if you are wondering about what to do, I would just say talk to your advisor. If you're thinking about some of those risks, whether it's sort of the consequences of bond yields rising and what that could mean for growth and activity and so forth, you know, if it starts to put stresses on some parts of the global economy, if you're worried about those uncertainties around the Middle East, you know, the best thing to do is just have a well-diversified portfolio that errs on the side of defensiveness. So I think taking advantage of some of those higher interest rates is a good thing to do, because looking ahead, at some point you could see things change. And I think within your share portfolio, you want to be focusing on the more defensive equities, maybe have a bit of gold, maybe have some energy stocks to hedge your bets. Those are the sorts of things that can prove to be good insurance policies when you have geopolitical conflict or other sort of uncertainties like that. So talk to your advisor and just check in to see how you are positioned. Looking back at last week, I guess I'll try and whiz through this as quickly as possible. The local CPI report, we had that come through. That was for the quarter of September. Softer than expected. Great to see. Came in at 5.6%. Forecast were for 6.0 from the RBNZ. The market was looking for 5.9, so it came in lower than expected. That's good news. the lowest in 2 years. However, we're not out of the woods yet. All of that weakness was driven by tradables inflation, which is the international inflation. We look at non-tradables, which is domestic inflation, and this is the one that is probably a bit more structural, but harder to get under control when it starts to get out of hand. That wasn't any worse than expected, but there was no positive surprise either. So I guess you could say, look, good news, but not for the reasons that we were hoping for. I think the Reserve Bank would have preferred to see non-tradables inflation come down a little bit, but still a good thing to be at 5.6 instead of in the sixes. That's absolutely progress. So let's still be encouraged by that. There's one more Reserve Bank meeting this year. In about 5 or 6 months' time, 5 or 6 weeks' time, I should say. No change expected, and then we sort of move into next year. And with a bit of luck, they're done. With a bit of luck, the OCR is as high as it will go. I did record an episode about whether people should fix or float and for how long, and that talked a lot more about sort of where the Reserve Bank is at, where inflation is at, and how I'm thinking about things at this juncture. So go back and have a listen to that one if you want to hear a few more thoughts. We also had another dairy auction, and it was another good one, the fourth rise in a row. The GDT index up 4.3%. So we've now seen a rebound over the past 2 months of about 16.9%. That comes on the back of prices falling to a 5-year low in mid-August. So good to see for the agricultural sector. Fonterra has upped its payout forecast from a midpoint of 6.75 to 7.25. So great to be back in the sevens. Could be another increase to come if the current trends continue. We'll just have to wait and see, but great that prices have pushed up a little bit. We also got some Chinese data out. We got the GDP figures for the September quarter. They came out very quickly in China. Other countries take a little bit longer to release their numbers, but this was better than expected, 4.9%. At an annual level. So that's down from the previous quarter, but it's above where people thought it would be. So better than expected. And when you look at some of those activity indicators for the month of September, industrial production, retail sales, they were also better than expected. So China's still got a lot of challenges, but most indicators now point to stability and things having stopped deteriorating. So that's good news too. Looking ahead to this week, obviously a little bit quieter on the local front. We've got a holiday shortened week with Monday being a public holiday, and it's pretty quiet in terms of economic releases too. But there are some AGMs that we should watch, some annual meetings. With annual meetings, you often get trading updates, so that could provide some corporate news. EBOS on Tuesday, Wednesday, Move Logistics, Scalar Up, Freightways on Thursday, and on Friday, Port of Tauranga, Fletcher Building, Sky City. So quite a lot going on the corporate front locally. Moving offshore, there's some important inflation figures across the Tasman. The Q3 CPI is out on Wednesday afternoon, 1:30. Markets see the annual rate of inflation slowing to 5.2%. That'd be the lowest in a year and a half, so that'd be good news, similar to what we're seeing here in New Zealand. The trimmed mean CPI is the one that you need to keep an eye on because it's the one that the Reserve Bank of Australia watches, and it's expected to come down as well. Markets are expecting it to slow to 5%, 5.0. That'll be the slowest in 5 quarters, down from a peak of 6.9. So the Reserve Bank of Australia is, of all the central banks that are meeting over the next little while, it's probably the one that I'm watching the most closely. Their next meeting is on Melbourne Cup Day. And there is a chance that they hike interest rates again. They've been on hold for a little while, but markets see a 30% chance of them moving in 2 weeks' time. And something that will be crucial to whether they do that or not is what the CPI release looks like on Wednesday. So that is definitely something to watch. Other central banks, whether it's the Reserve Bank of New Zealand or the Federal Reserve, or the European Central Bank, largely seen on hold at their upcoming meetings. But the RBA is probably the one where, it could potentially go either way. So keep an eye on that inflation report. We'll get the PCE inflation in the US. This is the inflation measure that the Federal Reserve keeps a close eye on. So that is always very important. It's due overnight on Friday, and it's the last big release ahead of the next Federal Reserve decision, which is next week, actually. No one sees any chance of a move there. And I don't think, unless you get a real surprise in the PCE figures, I don't think this will have a big impact, but it's still something to watch because inflation has come off generally over the last year or year and a half in the United States, but we have seen it push a little bit higher, at least at the headline level in the last 2 or 3 months. So keep an eye on that PCE as well. Central banks meeting this week. We've got the Bank of Canada and the European Central Bank. I think they're on Wednesday and Thursday, respectively. The Bank of Canada could move, but probably won't. I think markets are pricing something to the tune of about 15% in terms of the likelihood of a hike. So an outside chance, but pretty low. The ECB, very unlikely they'll do anything. Most people seem to think that they are done, and with their policy rate at 4%, they are probably at the top, but certainly nothing expected from the ECB this week. Economic releases, the flash PMIs will be out for the major regions. So these are economic activity indices. We get them very quickly, so these will cover the month of October. It'll pretty much be the first economic indicator we get for October. Always in focus because it's something that's very timely. So we'll get the numbers for Australia and Japan on Tuesday during our trading day. The UK, the European and the US figures will come out overnight that evening. Last but not least, the international reporting season. This will really ramp up this week. I think we've got 160 odd S&P 500 companies due to report, so it's the biggest week of earnings in the US. And Tuesday in particular, a very big day. 3M, Microsoft, Coca-Cola, Alphabet, that's the owner of Google, and Visa, all reporting on Tuesday. Boeing and Meta, that's Facebook, on Wednesday. Thursday, another big day right across the world, not just in the US. Unilever, MasterCard, Republic Services, Ford, Amazon, Intel, all on Thursday. And at the back end of the week, ExxonMobil and Colgate-Palmolive on Friday. So there'll be plenty more companies than that. Those are just some of the big names that caught my attention to keep an eye on. So far, it's been pretty mediocre. We've only seen 20% of the index having reported, the S&P 500, but yeah, so far a little bit soft. I've had companies like Tesla that have disappointed the market a little bit, and aggregate earnings are expected to be down slightly this quarter on a year-on-year basis. So things a little bit soggy, but hopefully we can see a few decent releases come through from some of those heavyweight companies and maybe provide a bit of optimism against a reasonably subdued market backdrop. All right, that's all, team. Hopefully that is useful. Let's close it up there. Enjoy your week. Enjoy what's left of the long weekend, and we'll talk again soon.
Got a mortgage coming up for renewal? Always tough to decide whether you should float, fix, and for how long. If you want to hear our thoughts on what you should consider before making these important decisions, take a listen to this.
For more insights, visit craigsip.com.